In 2008, when the global financial system nearly collapsed, it wasn't because banks suddenly stopped making money. It was because millions of borrowers, especially in the US mortgage market, couldn't repay their loans. Banks had piled into lending in securities that looked safe. But when defaults started to rise, it set off a chain reaction. That's credit risk. And when it's underestimated, it can bring down even the biggest institutions. Credit risk is the risk that someone won't repay the money they owe. On the surface, it sounds simple. Will the borrower pay you back or won't they? But for banks, which lend out billions across mortgages, credit cards, corporate loans, and government bonds, managing credit risk is one of the most important and complex tasks they face. Think about it this way. If you lend a friend £50 and they don't pay you back, it stings, but life goes on. Now imagine that happening thousands of times over with loans worth millions each. Suddenly, you're not just dealing with a loss, you're looking at the kind of problem that can wipe out a bank's capital and shake confidence across the whole financial system. That's why banks use a range of metrics to measure credit risk. One of the most important is probability of default, or PD for short, which estimates how likely it is that a borrower will fail to pay. Now, banks don't just guess this number, they calculate it using historical data on how often similar borrowers have defaulted in the past, internal credit ratings that map to long-term default rates, and statistical models that link financial health, industry risks, and even behavioural patterns to the likelihood of default. For example, if out of 1,000 small businesses with similar financial profiles over the last 5 years, say 50 defaulted, that gives a baseline PD of 5% for new loans to similar firms. For retail loans, PD might be informed by credit scores, repayment history, or how much of a credit limit a borrower regularly uses. And because risk changes with the economy, banks also apply forward-looking adjustments, stress testing what happens to PDs if, say, unemployment rises, interest rates increase, or house prices fall. Another key measure is loss given default, or LGD for short, which looks at how much the bank stands to lose if that borrower does default. For example, a mortgage might recover some value if the house is repossessed and sold. LGD is worked out by taking the exposure at the point of default and subtracting whatever the bank expects to recover after selling collateral or going through legal proceedings, adjusted for the costs of recovery. The remainder, expressed as a percentage of the original loan, is the LGD. For example, imagine a borrower defaults on a £200,000 mortgage. The bank repossesses the property and manages to sell it for £160,000. Say after £10,000 in selling and legal costs, the bank is left with £150,000. That means it's lost £50,000, which works out to an LGD of 25%. The same principle applies to corporate loans, where the recoveries might come from machinery, receivables, or other pledged assets. But the idea is always the same. How much is really lost once everything possible has been recovered? The third is exposure at default, or EAD for short, which measures how much the borrower owes at the point they default. EAD starts with the outstanding balance of the loan, but it also considers whether the borrower could draw down more credit just before default. For example, using the rest of an overdraft or revolving facility. To capture this, banks apply something called a credit conversion factor, which estimates how much of the undrawn portion might realistically be used. For instance, if a company has a £10 million loan facility, £7 million already drawn, and regulators assume a 75% drawdown on the £3 million undrawn portion, then the EAD would be 7 million plus 75% multiplied by the 3 million, giving 9.25 million. For retail loans like mortgages, it's simpler. If a borrower defaults owing £180,000, including unpaid interest, the EAD is £180,000. In other words, EAD is about the size of the risk at the moment of default, not just the original loan amount. Together, PD, LGD, and EAD form the foundation of expected loss, which is simply the average amount the bank expects to lose on its loans over time. For example, imagine a bank grants a company a £10 million loan. Based on the borrower's credit history and financial ratios, the bank estimates a 5% probability of default. If the company did default, the bank calculates that it could recover 60% of the loan by selling collateral and other assets, meaning the loss given default is 40%. The exposure at default is £10 million, or slightly higher if part of the facility was undrawn but expected to be used before default. Multiply those three figures together, 5% multiplied by 40% multiplied by the £10 million, and the expected loss comes out at £200,000. In practice, the PD is estimated using historical default data, the LGD comes from valuations of collateral and recovery rates, and the EAD comes from the outstanding balance plus any undrawn credit facilities that could be used before default. Now, banks also track non-performing loan ratios, or NPLs for short, which show the share of loans that have stopped being repaid. They measure credit spreads, i.e. the extra interest borrowers might pay above a risk-free rate, which widen when risk rises. And they run stress tests, modelling what would happen to their portfolios if unemployment spikes, house prices fall, or businesses fail. Now, these metrics don't guarantee safety, but they give banks a way to quantify and prepare for the risk they face every day. When managed well, credit risk is the engine of banking. It's how banks earn interest, support businesses, and help people buy homes. Diversification across industries, regions, and borrower types reduces the danger of one shock bringing everything down. Strong capital buffers gives banks a cushion against losses, and robust underwriting standards mean loans are given to borrowers who are most likely to repay. But when it's not managed well, credit risk can snowball quickly. The global financial crisis showed how risky lending, weak controls, and misplaced confidence in rising house prices could take down not just individual banks, but the system as a whole. Even on a smaller scale, banks that lend too aggressively or ignore warning signs can end up with high default rates, capital erosion, and ultimately a loss of trust from depositors and investors. At its core, credit risk matters because it's about trust. Trust that borrowers will repay. Trust that banks will stay strong, and trust that the financial system can weather shocks. It's a balancing act. Too much risk-taking and defaults can spiral into collapse. Too little and banks won't lend enough to support growth. So the next time you hear about tighter lending standards, higher loan loss provisions, or regulators stress testing banks, remember what's really at stake. It all comes back to credit risk. Get it right and banks stay profitable, resilient, and stable. Get it wrong, and the consequences ripple far beyond finance, affecting businesses, households, and entire economies. At the end of the day, credit risk isn't just a banking issue, it touches everyone. Whether you're applying for a mortgage, using a credit card, or simply trusting your savings to be safe. And that's why it's one of the most important forces shaping the financial world we all live in. If you found this video helpful, don't forget to like, subscribe, and hit that bell icon for more videos just like this one. If you're keen to learn more about finance, be sure to check out theindustryportal.com, link in the description below. Thanks so much for stopping by, and as always, keep growing, keep learning, and I'll see you in the next video.